Hello, welcome back. So in today's video, I'll be talking about my riskiest positions in my stock portfolio today. So in today's video, I'll be covering a few things. I'll be covering my riskiest positions in my stock portfolio, stocks that I'm planning to add, as well as some questions that you guys have left me in the comment section below. So let's go through the first portion first, which is my riskiest positions. And these are my holdings in my portfolio. So I have Visa, S&P Global, Amazon, Microsoft, Meta, MSCI, some Singapore stock, Google, as well as United Health. So before I talk about the first stock, let me play you this clip over here. This is from Dev Kantasaria.
Made by the leaders today. But you take something like Google search. ChatGPT just came out with their plan for ChatGPT search. Other companies are working on search. I think search looks very different 10 years from now than it does today. And what does that mean for a company like Google? The implications as a society from AI, I'm more clear on.
So the first of my riskiest holding is Google. So as Dev Kantasaria said earlier, he doesn't know how Google search will look like 10 years from now. And I generally agree with him as well. The stock is down 4% year to date and currently trading at a 20 times earnings. So for Google, they've been having a lot of good news these few days. So today as well, Google actually struck the deal with OpenAI to have a Google Cloud deal. And this is actually quite bullish for Google as well, as ChatGPT is trying to reduce its reliance on Microsoft. And Google is also leading in terms of AI LLMs. So Google currently has the best LLM out of all the different platforms, and it is a company that is leading AI right now. But for Google search, no matter how big Google Cloud gets, in 5 years' time, search is still pivotal to Google's success. And without Google search, the company will fall. So I'm not concerned about the macro trends relating to Google. I'm concerned about the constant need for them to innovate to stay ahead of the game. Amazon doesn't need to. Microsoft doesn't really need to as well. S&P Global and Moody's don't need to as well. But for Google, they're going to have to do it because they need to defend their share in terms of search. And for Google search market share, their search market share actually dropped below 90% for the first time in many years. And for Google, they also have the DOJ lawsuit overhang as well. So the DOJ lawsuit settlement will be in August, and if they lose Chrome, that will be 50% of their 60% of Google search earnings, and that will be basically a 30% drop in terms of their earnings straight away. And so Google will likely appeal, they already have, but let's see how that one plays out. If Google lose Chrome, then it will be extremely bearish for this company. So this is why I might trim Google. So it's more of a portfolio management rather than a lower conviction in the stock. Google is probably the highest risk stock in my portfolio today, and it is my largest position as well. So I have around 12% of my portfolio in just one position, which is in Google. Google still trades at an amazing valuation, and if next year there's no more DOJ, we could easily see Google trading at 30 times earnings if it continues leading in terms of AI. So I'm not bearish on Google by any means, but it's just more of a portfolio allocation strategy. And I feel more comfortable having a lower percentage of my portfolio in Google because Google is one of the higher risk ones out of all my positions in my portfolio. So the second riskiest stock in my portfolio is United Health. So United Health this year is down around 40% year to date, currently trading at a 12 times earnings with a 3% dividend yield. So for United Health, it's been hit with a lot of news recently. So there's been a lot of fraud talk and a lot of whistleblower case. And United Health, they actually sued The Guardian for looking to capitalize on the CEO's murder. So the one on the left is with regards to The Guardian coming out with an article to slander United Health, saying that they overcharged and was engaged in some form of Medicare fraud, which caused the stock to drop around 7% in one single day. And on the right is the DOJ prop that they're currently having right now. So the court ruling for the Medicare fraud is on 3rd July, which is around 31 days away, based on this X post. So there are three possible outcomes. Number one is the dismissal of the suit, which would end your DOJ claims without penalties for United Health. Number two, if the appeal is successful, the case could go to trial, where a jury would determine whether United Health's billing practice violated the False Claims Act. This could prolong the legal battle all the way until 2026. This is not a very good scenario for United Health. And then the more moderately bearish case is a settlement with DOJ shortening the trial and fining United Health of $2 billion. And the worst one is just United Health being charged $6 billion with additional penalties. So for United Health, it's a risky company with a lot of headwinds and hence the undervaluation, but it reminds me of AXP, American Express, and Warren Buffett. So American Express back in the 1960s, they had the oil scandal that caused the stock to drop actually 50% in just a few months alone. So this is the American Express oil scandal. So the American Express oil scandal, or the salad oil scandal, was a major corporate fraud in 1963 that involved forged warehouse receipts and led to millions of dollars in losses. And American Express actually dropped 50% because of this scandal. And the fraud was worth around $1.8 billion in today's money. And Warren Buffett, after this scandal, when the stock dropped around 50%, determined that the company will likely be unaffected by this case, and he bought most of his American Express stake during that time when the stock dropped 50%. So for United Health's valuation as well, the stock is now currently trading at a 12 times earnings. So the EPS right now is around $24, and assuming a 20% EPS drop to around $20 this year, and assuming a 10% EPS growth for the next 5 years, then 18 times earnings. The 5-year mean for United Health in terms of its PE ratio is around a 20 times. So assuming an 18 times earnings, the stock right now will give you around a 16% CAGR. So it's clearly undervalued even with this conservative estimate. It's a 20% drop in the EPS. So we have to see what the guidance is on 29th July. United Health will be releasing their earnings on 29 July, and on that day they will likely give out guidance as well. I expect the management to give very low guidance just so they can beat it, but let's see how this one plays out as well. Next portion, I'll be talking about what I'm planning to add in my portfolio. So the T-bills in Singapore, they're actually now around 2%. This is a historical low rate in the past few years, while the US T-bills are up at around 4.5%. So there's quite a divergence over there. But the problem with allocating my money into US T-bills is simply just the currency depreciation. So in Singapore, they have a ban, but over the past few months or so, the dollar has actually depreciated against the Sing dollar by around 6% or so. So the currency is a big problem. So I'm thinking of deploying my cash. I have quite a substantial percentage of my portfolio in cash. So the first stock that I'm looking at adding right now is MSCI. So for MSCI, this is their free cash flow profile. It's simply just incredible. You will unlikely find a better company that has a better free cash flow profile as compared to MSCI. So for MSCI, here are some of the metrics as well. The company is just incredible all around. ROIC at 25%, ROCE at 40%, stable revenue growth over the past few years between 10 and 12%. And in 2020 as well, even during the COVID bear year, MSCI actually had an 8% revenue growth. And over the past 10 years, the only time where your ETF inflows became negative was in 2017. And even during that year itself, MSCI's earnings actually came out positive. So overall, this company is a high quality compounding machine. And currently for MSCI, it holds around a 25% market share in your index provider industry, and it has incredible network effects. So for MSCI, this is their competitive advantage. It's switching costs. So over here it says, this level of integration creates substantial switching costs. Replacing MSCI often means overhauling internal systems, rewriting client mandates, and redoing regulatory disclosures. For most firms, the disruption far outweighs the potential cost savings. So for MSCI, about 50% of their customers are asset managers, 10% are hedge funds, banks, and so on. And MSCI is deeply integrated in a lot of the workflows of its clients. And that is a very substantial moat for MSCI on top of the network effects for MSCI. So for MSCI, it's a quality business. It is currently trading now at a quite high valuation. I'm looking at possibly adding into this position. It is a high quality compounding machine that will give me slightly above market returns over the next few years. So this is one that I'm considering right now. The next company is Copart. So similar to MSCI, Copart's free cash flow profile is just incredible. This is Copart's free cash flow. So for Copart, the metrics are quite incredible as well. Revenue growth of around 10 to 12% as well. And ROIC of between 13% and 17%. And ROE of 18% to 23%. So this company clearly has incredible metrics. And for Copart, here are some of the competitive advantages for the company. So number one is simply just high barriers to entry. So for Copart, it owns a lot of land. And even its closest competitor, which is IAA, they don't own the lands as well, they lease the lands. And when they lease the lands, the problem with that is it will eat into a lot of their earnings. And so for Copart, they own a lot of these lands, and it is very hard for competitors to come in and buy a substantial amount of land, simply because the cost of starting up a business like what Copart does is too high for them to come in and take share. So the next one is just your network effects. So more people on Copart's platform leads to even more people on Copart's platform, which leads to even more people and so on. So Copart has an auctioning platform that is expanding globally, and I expect them to continue doing so. And the last one is simply just scale. Copart has been steadily increasing their market share against their competitor, which is IAA, over the years. And for a company like Copart, it is again a high quality compounding machine similar to MSCI. So last portion, I'll be talking about some questions that you guys have left me in the comment section. So the first one, it says, love the videos, not sure if you're aware of buy now pay later, but I genuinely believe they are going to continue to perform well. It is definitely higher risk, but I currently track a firm. I believe lower income and moderate income families will continue to take advantage of this service, especially with the growing interest in concerts and so on. I see a lot of upside coming. It was originally showing only negative returns, but look at a firm's most recent earnings in addition to their recent partnership with Costco. So for me, buy now pay later is terrible for the consumer in the long term, and for a firm, it's a company that is exposed to credit risk. So for buy now pay later, and especially when you're targeting low income companies, a lot of this debt could eventually become bad debt. And for financial companies, I typically avoid the ones that have credit risk, so like your banks, your fintech companies, and even a firm in this case. So for a firm, even though it has positive growth this year, I don't think I'll be investing into this one simply because of the credit risk itself. And I saw another company, which is DoorDash, doing something similar as well, which is your buy now, pay later in food. I think it's a terrible, terrible marketing ploy for the consumer. And overall, buy now, pay later is just terrible for the consumer. Next question, thoughts on Pinterest? Solid fundamentals, consistent sales growth, and undervalued. So for Pinterest, the stock is currently up around 14% year to date, currently trading at a 14 times earnings. So for Pinterest over the past few years, their margins are extremely thin. So this company has an operating margin of around 5%, and the net income margin is likely to be around single digits as well, probably around 2% or so. So for Pinterest, I think it's a popular social media platform amongst the youth. But for me, I think the best social media companies are simply just Facebook, Instagram, and so on in Meta, as well as Google, YouTube. So I don't think I'll be interested in Pinterest, and I don't think there's a substantial moat in this one. I hope you guys have found this one useful and invest safe.